Last time we balanced T accounts. We watched our bank account fill up with entries. Some on the debit side, some on the credit side, and then we balanced the account. Today then, we're going right back to the beginning, to where a lot of these entries actually start from, to the source document. So before any money reaches our bank account, somebody has to raise an invoice. Let's call this one number 102, date 21st of August 26, from a company called ABC Builders. That's the invoice. This will be for us, it could be for anything. This is for electrical work. Let's say it's $500. And there's GST on top of that, $75. And the total owed is $575. This is where the life cycle of a sale usually begins. And an invoice contains some basic information: who it's from, who it's for, what was supplied, the invoice number and the date, the amount charged, any GST, total, and usually payment terms. And depending on what country you're in, certain information about your business. We're not going into all the details of creating the invoice today. When we get into Zero later in the series, we'll look at exactly what goes into an invoice and how you create and send one. Does raising invoice mean you've been paid? No, not even close. An invoice is a request for payment. An invoice tells your customer what they owe you and asks them to pay it within a certain time. It says, I did the work, or I supplied the goods, and now you owe me. Remember all the way back in episode 1, cash is not profit. Well, this is the other half of that idea. For a typical sale, when we raise the invoice for work we've done or goods we've supplied, we recognize the income in our accounts, even though we haven't been paid yet. So you could send an invoice today, recognize the income, and not see the cash for another 6 weeks. That's because in accrual accounting, we don't wait for the cash to arrive before recording the sale. So who owes you money? Debtors. When a customer owes you money, they're called a debtor. You'll also hear the terms account receivable, shortened to AR, same thing. Debtors is the plain English term. Accounts receivable, or AR, is a more formal accounting term. Let's put our invoice through our accounts. We can call this a debtors account. And we'll need another account, sales, because we're making a sale. This is our sales account. So to put our invoice through our accounts, we create a debtor of $575. We need to put it into our debtors. Debtors is an asset account, if you remember. Assets go up on the debit side, so we need to put it, let's call this invoice 202, 102, 575. We'll debit debtors 575. The corresponding credit, in fact, in this case, there are two. You know, every transaction has at least 2 footprints. Some of them have 3. This one's got 3. Our sales aren't 575. Our sales are 500. So we will credit sales, invoice 102, credit sales with 500. Remember the dead click sales is an income account. They go up. When sales goes up, it goes up on the credit side. So we credit sales account 500. They still don't balance, so we need another account. We need to account for the GST. So this is our GST account. GST is a liability. In other countries it's called different things. In the UK, VAT, similar to a sales tax in the USA, not strictly. So our GST account is a liability. Liabilities go up on the credit side. Our liability in this case for GST is $75, so we need to credit $75. This is recording the income. We've created a debtor 575. We've created a sale of 500, or rather we've recognized the sale of 500, and we've created a liability of 75. Here's a little memory aid that might help you. The word debtor comes from an old Latin word that means to owe. So a debtor is simply somebody who owes us money. Now, I'm using debtors here as the overall account for amounts owed by our customers. Behind this total, the accounting system normally keeps an individual account for each customer. The debtors account is just the total of all those individual customer balances. They're kept in a subsidiary ledger. Talk about that later. Now, 6 weeks have gone by and the customer pays us. So we get the total amount, 575, paid into our bank account. The bank's an asset account. Assets go up on the debit side. So that's invoice 102. $575. The corresponding entry, we don't affect GST again. We've already recorded that we owe 75. We don't change our sales at all. The corresponding entry to this is we'll credit debtors with 575. Remember, debtors is also an asset account which goes up on the debit side. In this case, we're reducing the debtors by 575. So it goes on the credit side. And the effect of this transaction, this debit and this credit, the effect of that is our debtors balance out to zero. We don't have any more debtors. So all that changes is we've exchanged an asset. A debtors is an asset. We've exchanged one asset account for another. We don't have debtors, but now we've got 575 in the bank. Let's just pause on GST for a minute. We'll cover it in more detail later on. We've got a mini-series about GST. In New Zealand, GST is a 15% tax on most taxable supplies. As I already said, in the UK, it's known as VAT. It's similar to a sales tax in the USA. But this GST, which you add to invoices, in this case, $75, that's not our income. That belongs to the inland revenue. The business is collecting the GST on behalf of the taxman, on behalf of the IRD. So we owe that to the taxman. It's collected over here. We keep a record here of what we owe them. And at certain points in the year, depending on the business, it's different times of the year, we have to pay it to them. So keep it, don't spend it. So that's an invoice that we've sent to one of our customers. What happens when the shoe's on the other foot? What happens when our supplier sends us their invoice? Well, that's for next time. We'll see you then.